Imagine it's 1992. You have a sum of money to invest, perhaps saved up from years of hard work or a fortunate windfall. The question looms, where should you put your money to secure the greatest wealth by today? Stocks or real estate? Over 3 decades, the answer to this question has shaped the fortunes of millions, quietly determining the lifestyles, opportunities, and security of countless families. Let's explore what might have happened to your wealth if you had chosen one investment path over the other. If you had chosen to invest in the broad U.S. stock market, specifically by putting your money into an S&P 500 index fund, you would have tapped into the collective fortunes of America's largest companies. Historical data tells us that from 1992 to 2024, the S&P 500 delivered an average annual return of about 8.27%. That means every dollar invested at the start of 1992 would have grown nearly tenfold by 2024. For example, if you invested $10,000 in 1992, by 24, your investment would be worth roughly $96,000, assuming you reinvested all dividends and let the power of compounding work its magic. The growth is exponential, illustrating how time in the market can be far more powerful than timing the market itself. Now let's consider the alternative, putting that same $10,000 into U.S. residential real estate. Over the same period, the average annualized growth rate for housing was about 5.5%. This slower, steadier increase means that your investment would have grown to about $57,000 by 2024. While this is still a significant gain, it's notably less than what you might have earned in stocks. However, real estate often offers something stocks do not: the ability to leverage your investment. With a mortgage, you could control a much larger asset with less money down, potentially amplifying your gains if the property appreciates and generates rental income. But numbers alone don't tell the whole story. Stocks and real estate each offer unique benefits and challenges. Stocks are highly liquid. You can buy or sell them in seconds with the click of a button. This makes it easy to adjust your strategy, respond to market changes, or access your money in an emergency. However, stocks are also volatile, and market downturns can wipe out years of gains in a matter of months. Emotional resilience and a long-term outlook are essential to weathering the storms. On the other hand, real estate is tangible. You can see it, touch it, and even live in it. Owning property offers a sense of security and permanence that pieces of paper or digital entries might not. Real estate can also generate passive income through rent, and it comes with tax advantages like deductions for mortgage interest and property taxes. Yet, it's far less liquid. Selling a home or investment property takes time, money, and effort. And don't forget the responsibilities. Repairs, maintenance, and dealing with tenants can turn a passive investment into a part-time job. Ultimately, if your goal is to maximize wealth based purely on historical returns, stocks have generally outperformed real estate. But if you value stability, tangible assets, and the potential for passive income, real estate has its own appeal. The wisest investors often blend both approaches, diversifying their portfolios to capture the growth of the stock market while enjoying the stability and income of real estate. So if you had chosen stocks over real estate in 1992, you would likely be significantly richer today. But wealth is not just measured in numbers. It's also about peace of mind, security, and the lifestyle your investments can provide. The best choice is the one that matches your goals, your risk tolerance, and your vision for the future.